The bank creates money out of nothing and gives it to D. Many people don't understand how money really works because they think it's a commodity like gold. But that's not the case. So in this video, I'm going to explain with a simple example economy how the system really works and compare it to a system where gold is used as money. Based on that, I'm going to show the up and downsides of the current system and bust some myths that many people believe about money. To introduce our simple example economy, let's look at it first without money. That way, we can also see why money is really useful. Say there's 3 people, A, B, and C. Each of them has grown an apple, but everyone prefers the apple of his or her neighbor. So A prefers B's apple, B prefers C's, and so on. So what can they do in this situation? Well, they can all meet and trade apples in a circle. Say further that A has grown a second apple that he doesn't want to eat right now. So he brings it to a bank. The bank in turn promises A to pay him back an apple plus interest in the future. Now the bank needs to find someone, let's call her D, who wants to borrow an apple. Let's say she wants to plant an apple tree with it and promises to repay the bank an apple plus interest at a later time. The bank records the loan to D on one side of its balance sheet and the loan from A on the other. After D has repaid the bank in the future, the bank can repay A and all transactions are concluded. So far, so good. However, over time, A, B, and C get tired of always having to meet all together to exchange their apples. So they decide to use gold as a medium of exchange. They agree that one apple is worth 1 gold coin. A happens to have a gold coin, so he can go to B, buy his apple, and pay with the gold coin. After this, B can go to C, and so on. Again, A wants to save, so let's say he brings the gold coin to the bank. The bank lends out the gold to D, who can use it to buy a second apple. The bank records the loan to D on one side of its balance sheet and the loan from A on the other. Note that in a monetary economy like this, the bank doesn't deal with goods at all anymore, but only with money and claims on money, which is gold in this case. However, in this system, it still needs to have deposits before it can give out a loan. Note also that A has now a decision whether he wants to hold his wealth as a claim against the bank and earn interest, or as gold, a durable asset that he can use at any time to buy something, meaning that it's liquid. If he has a high preference to hold it in gold and he doesn't care about earning interest, then he doesn't bring it to the bank, and the bank can't give out a loan to D, and therefore D can't purchase the apple. D might end up unemployed, despite her ability and willingness to do productive work. Further, A wouldn't be able to sell his second apple. Let's look one last time at this economy, this time when modern fiat money is used, meaning money that doesn't have an intrinsic value. This is the system in place today all around the world. In the modern system, money is created out of nothing, for example, when a bank makes a loan. Let's say there's no money in circulation initially. This means before anything can happen, D has to take out the loan. The bank creates money out of nothing and gives it to D. In turn, D promises to repay the bank at a later date plus interest. The bank simply records the loan to D on one side of its balance sheet and the newly created money on the other. Note that in this system, the bank doesn't need any pre-existing deposits for this. D can now use the money to buy an apple from A. Then A can go ahead and buy an apple from B, and so on. At the end, A can lend the money to the bank to earn some interest. In this case, the money stops existing and the bank records the loan from A on its balance sheet. Instead, if A decided to keep his wealth in cash and not bring it to the bank would simply make higher profits because it wouldn't have to pay interest to A. But other than that, nothing changes. Now let's compare the different systems. Barter is very unpractical, especially when there's a big group of people and a big number of different goods involved. With commodity money, that's already much better. However, it's still not ideal having to carry around a commodity like gold all the time. Also, you're using up real resources like gold, and there might just not be enough gold to support all transactions in the economy. Today, all the gold in the world simply wouldn't be enough to support a global gold money system. There's also problems if people hold on to their gold too much, as shown in the example with A. On the other hand, the value of gold is somewhat stable by itself. In the fiat money system, there's no dependency on a raw material like gold. Also, no real resources are used. In our example, A could use his gold to make his wife some jewelry. It's also more practical since people don't need to carry around gold all the time. However, the system is more fragile since the value of money effectively depends on the quality of bank loans and the rate of inflation. Hence, there's a need to regulate banks to prevent reckless lending and implement sound monetary policy. To summarize, if run well, the fiat money system is the best system to run an economy. Now it's time to address some common myths about money that come from a flawed understanding of the fiat money system. First, banks need deposits to create loans. That's wrong. Banks create new money when giving out loans. Following the same logic, people think savings are necessary for investment. But it's the other way around. Investment creates the money that people can save. Third, people think that money is limited. But we don't live in a gold money system anymore. In theory, money can be created indefinitely. Also, people think the amount of money is fixed, for example, by the central bank. But that's also wrong. Normal banks can create money, for example, by giving out loans. There is also this notion that debt is always and everywhere a bad thing. But without debt, there couldn't be any money, and money is essential for the economy. Lastly, people think that the monetary system is intrinsically stable. But money depends on banks, and banks are very unstable left to themselves. So someone needs to make sure that the banks are stable for the system to be stable. I hope you learned something. If you have questions, drop them in the comments below. Take care and stay interested.